The broadcast is now starting. All attendees are in listen-only mode.
Hi, everyone. My name is Lisa Roos. I am the Director of Long-Term Care Insurance here at One Resource Group. Sorry for the delay today. We had a little bit of technical issues here. So we thank you for joining us. We have Lawrence with National Guardian Life on the phone. He's going to be discussing why National Guardian Life should be your go-to LTC solution. He'll kind of go over the product highlights and some selling scenarios for you. So please put your questions in the chat box and we'll answer them at the end. And for now, I'm going to go ahead and let Lawrence take it away.
Lisa, thank you for kicking things off. I sure do appreciate it. And everyone, thank you for your patience. We had a little software snafu right in the last minute there. So Jacob over there at ORG is going to be running the slides for me off of a PDF, and we're going to make this all happen. So really appreciate you taking some time out of your day to join us and learn a little bit more about NGL and Essential LTC. So Jacob, if you would advance 1, 2, 3, 4 slides to the one that says National Guardian Life Insurance Company at the top. Because really when I just said we're going to talk about NGL and our product, that's pretty much our agenda for the day. I want to make sure you know who we are as a company, because you will get those questions. And I want to make sure you know how to position the product and what makes us unique in the marketplace. And that's really where we're going to discuss why we should be that go-to product in many scenarios, because this thing is a very flexible, moldable product that can fit many different client scenarios. So to begin, and I'm not going to spend too much time on who we are as a company, but I think you need to know how to answer those questions, right? Because clients might ask, well, who is this company? I don't know them. I've maybe not heard their name. Well, NGL is a mutual company. That is not on your slide, by the way. We're founded 115 years ago. It's a fun anniversary to be celebrating, 115. We're A-rated by AM Best, and we hold about $5 billion in consolidated assets. So generally, when I was working with consumers and I was in the field, I found people wanted to really know 3 things. How long has this company been around? How are they rated? And what do their financials look like? And we've got 3 great answers to those questions. 115 years, A-rated, about $5 billion in assets. Now, the savvier consumer might say, well, how long have they been in long-term care? Well, we partnered with an administrator who's been doing this for about 30 years. Excuse me, it's over 35 now. And they've done nothing but long-term care for that entire time. And they've done it for about a dozen different insurance companies. And everything from claims to new business administration to underwriting, you name it. So we jumped into long-term care partnering with this administrator in 2016. And maybe the average consumer might say, well, that's not very long. Do they know what they're doing? Well, not only do we rely on our administrator's experience, the industry experience behind that is tremendous. And here's where our story, I think, sets us apart from any other company in LTC planning. So we're a mutual company that's been around for 115 years with great ratings, great financials. And we have a clean balance sheet on our long-term care block of business. So if you don't know much about long-term care and its history, long-term care arguably got popular around the mid to late 80s, early 90s. And as an industry, we really didn't have much in terms of claims data, arguably until 2010 or so. And when we got that, as an industry, we realized, hey, we made some mistakes. We maybe underwrote a little too loosely. We priced too low. We overestimated lapse ratios, underestimated claims duration and frequency. Interest rates around 2010 didn't help either. So there was a lot of turmoil in this world, and that was around the same time you started seeing the first ever in-force carrier increases. Now, fast forward. NGL jumps in 2016 after the industry learns a whole lot the hard way. So, Jacob, advance one more slide. We now have a product that's competitively priced with some nice rich features you're not going to find anywhere else, because today we know how to underwrite this stuff. We know how to price this stuff. So you have an extremely flexible and moldable product as a result. And I think our value proposition as a carrier, being an old mutual company, been around for a long time, great ratings, great financials, and the other side of that balance scale has a clean block of long-term care business. We're not looking in the rearview mirror. We don't have any baggage that may have been created by some old, underpriced, poorly underwritten business. It's really a best of both worlds kind of a story. So that's the bit on who we are as a company, and I usually only take 5-10 minutes to talk about that. Jacob, if you could advance one more slide to the map. This map actually, because we're using that PDF, is slightly dated. The only state that should be gray is New York. I do a quick bit on product availability before I talk about products. We are available in every state with the exception of New York. Montana's that other gray one on the map, but we are available in Montana as of mid last year. Any questions on availability, I'm happy to answer them. But Jacob, if you'd advance one more slide. This really is our agenda for the rest of our time together, with the exception of maybe one thing I'll add in on the tail end. These are the features that make us unique in the marketplace and that make us why we should be that go-to solution in many situations. Don't feel like you've got to write them down. I'm going to talk about each and every one of them as we go. But before I do that, Lisa, any questions on who we are as a company or anything you want to interject with or anything you see in the questions pane before I move on to product?
No, just the only thing that we have is, do you plan on being in New York? Are you trying to get signed up for that?
Yes, we're working on various paths to get there. I don't think it's in the immediate future, but it's definitely something on our radar. I don't have a timeline to provide you at this stage.
Awesome.
Yeah. That's usually my first question on availability. All right. So to begin with the first bullet on your screen, let's talk about the joint and shared benefits. Jacob, if you could advance one more slide. I truly believe that if you were talking to couples about long-term care planning, which generally we're talking to couples, right, when it comes to a long-term care plan, NGL absolutely has to be an option on the table. At the very least, we have to be an option. And the reason is because of how we built this thing. And Jacob, if you could advance one more slide to the slide that looks like it has 3 blue circles on it. It says a policy structure with couples in mind at the top. Here's what I mean by that. So generally, with other carriers, you have to sell each person in the couple their own separate policy with their own separate premium, and you have to figure out what the sum of the 2 premiums happens to be to tell them here's what you're going to pay every month or year or whatever the situation calls for. With us, we have one joint policy represented by that rounded rectangle on your screen. Within that joint policy, you have those 2 separate blue circles, which represent 2 totally and completely separate benefit pools. So in the example of $200 a day for 3 years, each one of those blue circles represents a $219,000 pool. 200 times 1,095 days, right? They will never, under any circumstance, do a lateral or go horizontally. They're never going to touch each other's pool within the joint policy. Even if one of them dies, that pool dies with them. But if you sell the shared benefit amount, you see those blue arrows that go down to that 3rd blue circle. That's a 3rd pool of money, which again, in the example of $200 a day for 3 years, is a 3rd pool of money worth $219,000. So really, there's 3 3-year pools within this policy if you use the shared benefit amount. And 3 pools of money worth $219,000. So if Mr. Insured goes on claim, he could use his whole pool. And then if he still needs help, he could tap into that shared benefit amount, that 3rd pool. Or if he doesn't, he wouldn't touch any of it. He could use all of it, some of it, none of it. It depends on what their situation calls for. But even if he went through all of his own pool and all of the 3rd pool, that 2nd person still has her full pool left. So unlike the competitive models where they share each other's policies, in our scenario, that second person will never be stuck with just a year or so worth of benefits left because of the beauty and the flexibility of this third pool of money. I spend so much time on this because I think, quite frankly, this is one of the best things we have going for us in terms of product features. Now, if we could advance one more slide, it says competitive scenario. I want you all to focus your attention towards the bottom of this slide and look at the two silver bubbles. We're on the left with our three pool model, competitive product on the right with their two separate policies. That is a $225,000 difference between those two numbers. That's not a small difference. And that is a day one difference. That doesn't even account for inflation over time. These folks are only 55 years old. So it is extremely advantageous in terms of a benefit availability and benefit flexibility type of a conversation. Now, as you may have already done, you look towards the top of the slide, you see in the black font, we're also about $1,200 a year cheaper in this example. So we're extremely price competitive for couples as well. And if you can't see the fine print on the bottom, I'm not hiding anything. It very simply just says, hey, this is $200 a day, 3 years, 3% compound, shared, generic state, most common rate class. So that kind of brings me back to the first very bold statement I made when I started talking about couples. And I said that NGL absolutely needs to at least be an option on the table when it comes to couples and long-term care planning. This is why, and I'm hopeful at this stage you all would agree with me. And it's truly just because of how we built and structured this policy. Any questions on this part, Lisa, or anything that's come in or anything you want to add before I move on to some other great stuff we've got going on?
Yeah, I just wanted to kind of reiterate basically what you're saying here is each joint insured is going to have their own standalone pool of money, and that third pool of money is going to, it's not like the other carriers out there, like you said, where they're leaving only 12 months left for, the survivor, correct? So they,
That's correct.
See what I mean?
They'll never touch each other's pools. So they'll each, at the very least, have their own pool in its entirety.
And so in this case, in this scenario that you ran the illustration for, is the $657 the protected assets under partnership?
Yeah, well, it depends on who uses what, right? Because partnership's a dollar-for-dollar asset protection based on benefits paid, right? So if one of them uses all of their own pool, all of the shared pool, and then needs Medicaid, right, it just depends on what paid to whom.
Okay.
Right. And, also depends on, are they surviving? Are they both alive, right? Because the sick person has to spend down to X, but the healthy person gets to keep Y. So it just depends, right? Because remember, Medicaid, every asset's a joint asset. You divide them in two, who's sick, who's not, where does it apply?
Right.
So it just depends on the scenario. But the thing to remember is it's still a dollar-for-dollar asset protection based on benefits actually paid.
Right. And are you guys a indemnity carrier or reimbursement? I don't know if you're getting into how claims get paid on the policy and what needs to be submitted and that kind of stuff.
Yeah, we can go down that rabbit hole. I can probably do a whole separate session just on claims. But the nutshell answer, we're a reimbursement policy. And if anyone has any further questions on that versus indemnity, I'm happy to dig into it and explain why reimbursement is actually a good thing and is a good protection for the end user.
Right. And one final question before we move. Oh, sorry. Go ahead.
Yeah, go ahead. No, you go ahead.
One question somebody had is because it's a joint policy, different from, you said it's all one policy, correct? So that means that the benefits have to be the same from one individual to the other. You couldn't have one at like a 3-year duration and another one at a 4-year duration or different monthly benefit amount, correct?
That's correct. Yeah, they would have to buy the same benefits, which generally is how this stuff is sold, unless you have somebody who had, an old existing policy from a workplace or something like that. But for the most part, folks are buying the same benefits. And yes, with us, you have to purchase the same benefits on a joint policy.
Okay.
Okay. So joint and shared, huge advantage from both a benefit flexibility, available features, and a pricing standpoint for us. Okay, Jacob, you could advance one more slide. That's the one with the bullet that says lifetime benefit period. I want you all to be aware that we do have a lifetime unlimited benefit period. We're the only traditional carrier that offers one. In fact, in the entire marketplace, even when you look at all the hybrids, we are one of 2 carriers that has this feature available. Okay. When do you use it? Well, there are some people that will pay any amount of money to know that come anything, they will never run out of benefits in their policy. Okay. That's when you check this box. There are some customers out there that say, I want lifetime or I want nothing. We actually have that box available for you to check. But an interesting alternative, if a couple is the one inquiring, remember what we just talked about. Say, hey, Mr. Insured, I can show you the lifetime you asked for, but NGL has this really interesting kind of niche with this third pool of money going on. What if I showed you 3 5-year pools of money? Statistically, most couples are not going to need 15 years worth of care. Is it lifetime unlimited? No, but it's the next best thing, and it is a whole lot cheaper. So there's some interesting plays you can pull out of your playbook there when someone asks for lifetime. With us, you can actually show them, but you can also be the hero and give them an interesting alternative that's probably more than they're ever going to need and save them quite a bit of money. So think about that. But for the single folks who want a really long benefit duration, you can offer them a 2, 3, 4, 5, 6 year or the lifetime. Okay, so those are our benefit period choices: 2, 3, 4, 5, 6, or lifetime unlimited. Moving on to the next slide that talks about our single and 10-year and lifetime payment options. We are the only traditional product anywhere in the marketplace that has a single premium payment option. It is fully paid up on day one. It makes the policy non-cancelable. We can never ask for another penny. It can never be subject to any kind of rate increase. So yes, you can sell guaranteed premium traditional long-term care insurance. I'm the only product in the marketplace where you can say that. Okay. Now, our 10-year premium payment option is also a very interesting thing to consider, in that with it, in every state except California, my 10-year premium payment option is also a day one guarantee on the premium. It can never get a rate increase. The only way that premium would change would be if they requested to decrease their benefits, which in turn would decrease their premium. Okay, now in California, you could be subject to an increase, but only during your 10 paying years. Once it's paid up in year 10, it is insulated from any potential increase in the future on that series of policy. So folks, in most states, you have 2 ways to sell guaranteed premium traditional long-term care insurance. That is with the single pay and the 10-year pay. Again, I started this conversation talking about how flexible and moldable this product is. Someone has a concern about old policies with increases, you have 2 ways to immediately remove that risk. But for those who maybe can't afford a single or a 10 pay, there's other ways to insulate that risk and have a conversation. Conversation we've already had on this call. Hey, NGL is a mutual company that's been around forever. And the long-term care insurance you've heard about, and I had someone from the South, I live in Tennessee myself, say, hey, today's long-term care insurance ain't your mama's long-term care insurance no more. That person's very near and dear to me, but speaks with that Southern accent, which I find endearing. And what they mean by that is, think about it. The product that was bought 20 years ago had all those assumption mistakes on it, had the underwriting mistakes and the pricing mistakes on it. The product that's priced and available today that came in the marketplace after the industry learned about all those things doesn't have those problems. And there have been various studies that talk about the likelihood of increases on current products today, which are slim. Now, since my contract on a lifetime pay does not say guaranteed premium, I'm never going to tell you that I will never have an increase. What I can say is that we've never had one to date, and we're currently not even thinking about an in-force increase. And the product's performing very well. And the product available today is not the product available from other carriers 15, 20 years ago. So I think we have a great story to tell about the lifetime pay. But if you want to guarantee a premium, single and 10 are available. Great features. Now, if we move forward to the next slide, it'll talk about return of premium and surrender. So I have ways on a traditional product to provide the same style features as a hybrid product. If we move again one more slide, it'll have that same, those asset-based link benefit, whatever you like to call them, it'll have that same story. And let's move forward one more slide. If you live and you need care, there could be a benefit. If you die and you don't, there could be a benefit. If you even think for a second you might cancel this thing, there could be a benefit. And move forward one more slide. Many of us call this live, die, or cancel, or live, die, or quit. You can provide that same story on a traditional product. We just use different language to get there. So if we look at the next slide that says return of premium riders, I want you to focus on the first half, because the bottom half of this really only speaks to a rider available in California. So let's look at that limited return of premium rider first. The way it functions is you look at premiums paid, you look at any benefits received as claim payments, and you subtract one from the other. If there's anything left, that amount goes to the beneficiary. Now, this usually makes me pause and look at it and go, hang on a second. Isn't this exactly how a hybrid policy works? Just the first stack of money is not called a premium, it's called a death benefit. And you reduce that every dollar for claims paid, and if anything's left, it goes to the beneficiary. Right? Just with us, it's different language. So you can provide that same live or die story. Now, the full return of premium, again, only available in California, so I'm not going to talk about it much, is premium regardless of claims. And if that policy is still active when somebody dies, that premium amount is going to go to the beneficiary. It is very expensive, which is why it's not available in all other states. It was not sold much, but it's still available in California. Now, I also have versions of these riders that look just like this, but if we move forward one more slide, there's versions that have a surrender value added to them as well. So if when they're living, they decide, nope, I don't want this thing anymore. On or after that 4th anniversary, they can surrender the policy for up to 80% of the premiums paid in. So that's your quit or your cancel part of the story. So what I love about the flexibility of this product is you can just sell live benefits, traditional long-term care insurance. Or you can add a limited return of premium rider, sell, live, and die. Or if you want the surrender value, you can add that too, and then you have your live, die, cancel trifecta. But why make people pay for the cancel if most people never cancel their long-term care plan? That's part of the flexibility I love within this product. So those are the main features that I think make us unique. Before I move on, Lisa, did any more questions pop in, or is there anything you wanted to add on any of those topics of lifetime or single pay, 10 pay, or return of premium?
Yeah, I do actually have a couple questions here. I'm going to kind of go back to the pool of money that we were talking about earlier, and that was if one person uses up their pool of money and then goes into the shared pool of money, does that mean that the spouse would end up with no shared pool of money?
So the only way the survivor would end up with no shared pool would be if the first person used all of their own pool and all of the shared pool. Okay. Which would be, it can happen, but if you sold, say, a 5-year benefit, that means one person would have to need 10 years worth of care, which statistically improbable, but it happens, right? So what I generally see is somebody uses all their own pool, maybe some of the shared. Then that survivor has all of their pool and whatever was left in the shared available to them.
Now, can one spouse have a different rating than the other on your product, or is it still the same rating?
Say that one more time, Lisa. Did you ask if they could have different rate classes?
Yeah. Like
So
the husband gets preferred and the wife gets
could.
standard.
So let's talk rate classes for a second, because in every state in California, we have what's virtually a single tier rate system. Just so you all never have to go back and say, gosh, I sent you in preferred, but you got approved standard. I'm really sorry, but it costs more now. So with us, we have one rate class called Premier. It's the only one you and I can quote. Generally, somebody's going to get Premier or they're going to be declined. We have a separate rate class called Select that's kind of in our back pocket, and it's for those on-the-fence cases where, it really it could be a decline, it could be an approval, but we'd feel more comfortable if we charged a little bit more. It is rarely used. We use it in about 4% of issued cases. That's how rare it is. So generally, you're going to get Premier or you're going to be declined. Have I seen scenarios where we have a joint policy and one of them's issued Premier and the other one's issued at that Select rate class? Yes, I have seen it. It does happen. But generally, you're going to see Premier. California works a little bit differently. I don't want to spend too much time talking about California, but if anyone has questions there, type it in the box and I'll go into that a little bit.
Okay. So I've got a couple more questions and then we can kind of move on. So you mentioned the ROP, and that the only state that we can get full 100% ROP is in California. So in other states, is it on a tier system, like, they get back? Is there ever a way that they can get 100% full return of premium after a time period?
Yes, let's unpack that because it's a lingo thing, okay? So the limited return of premium is available in all product states. In fact, there's one state, it's one of the Dakotas, I think it's North Dakota, they call it limited death benefit. They didn't like the words return of premium. But you can get 100% of your premium back with a limited return of premium rider. Think about how it works, and let's remember how it works. It is premium less claims paid. So if, please knock on wood, I'm an individual, I get out there, I get a long-term care plan, I paid in 50 or 100 grand to my long-term care policy, let's call it 100 grand, and I just get hit by a Mack truck and die when I'm 88. Premium less zero claims means 100% of my premium is going to that beneficiary. Okay. So the only thing in California was premium regardless of claims. And I don't see that rider coming up in too many scenarios other than a very, well done business, a C Corp type of a business that wants to maximize their tax deduction, because that is a very, very expensive rider in California. Where I see you maybe having some success is with a limited return of premium rider. But quite honestly, most of this stuff is sold without any return of premium rider. Old school, traditional long-term care insurance. Leverage your dollar for the most long-term care benefits for the least amount of premium, right? That's the essence of insurance, isn't it? We want to spend the least amount of premium to transfer the most amount of risk if something happens along the way. So the return of premium riders are nice, but I think when we side by side them, you'll probably find most of your success selling regular old long-term care without that rider.
Right. You may answer this next question later on, but I'll go ahead and ask it here. It's in regards to tax deductibility of the LTC premium. So on the hybrid products, it breaks everything down for the LTC cost separately from the life cost. Because this is a traditional plan, the NGL premium is completely LTC cost, regardless of any riders chosen, correct?
Correct. Even if you got an ROP, it is still 100% tax qualified long-term care premium. So you could, in the case of a C Corp, deduct the entire thing. There is no portion of my policy that is life insurance premium.
All right. Thank you very much.
Absolutely. Absolutely. Okay. So if we'll advance one more slide, we talked about one sales idea, which is comparing us to asset-based type products. The next one would be talking about tax deductions and business owners. We talked a little bit about C Corp. So let's advance one more slide. This talks about our unisex employer group rate class. Okay. and that is available in all product available states. We'll look at just about any business that has at least 5 employees. Minimum participation is going to vary between 2 and 5 issued employees, depending on the state. Fully underwritten policy, same benefit choices, same application, everything else is the same. Same comp even, because it's not a quote-unquote discount. It is a rate class. So, interesting thing there if you're talking to business owners or executives. Let's advance one more slide and just talk briefly about our tax summary. We already addressed the tax advantages available to traditional long-term care insurance. And I just want you to remember that no part of this will ever be a life insurance premium. So you could load this thing up, sell super high dollar policies. In fact, a couple of years ago, we had a business, it was towards the end of the year, and they deducted, I think it was close to $800,000 in single premium long-term care insurance. It was a tremendous carve-out case of executives all on a single pay basis, and it was a C Corp. It was a great story to tell. All right, let's advance one more slide and talk about one more concept. 1035 exchanges. Many people forget 1035 exchanges to traditional long-term care. Let's advance one more slide. The top of it should say Pension Protection Act. Many people remember the life insurance part. Most people don't remember you could also use non-qualified tax-deferred annuities. And you can use that, including the gains you never paid tax on, to pay for long-term care insurance premiums. And the benefits that come out the other end are tax-free long-term care reimbursements. So you've kind of waved your long-term care specialist magic wand there, and you turned what was potentially a taxable asset into tax-free long-term care benefits. That's a pretty tremendous story. Now, one more slide. Stuff to look out for. 3 bubbles in the bottom of the slide. Remember, I can't play with qualified money via Section 1035. That's not what it was designed to do, and that's not what the Pension Protection Act allowed it to expand to do. 2, this has to be a like-for-like exchange. Remember, I'm a joint long-term care product. So to transfer out of something, it would have to be a joint annuity. Now, for single folks, this will never come into play. Or if you had a survivor life policy, that could go into traditional joint long-term care, right? But I can't take just the husband's life insurance, stick that into joint insured LTC. I have ideas for you if that comes up. Don't feel like you hit a brick wall. Call Lisa, call us. We're happy to help. And remember, the bottom bubble, if you sold single premium long-term care insurance, even if it is a 1035, you sold guaranteed premium LTC. What a great story is that? And they never paid tax on the gains in the original policy. That's a win all the way around. All right, let's advance to the slide that says top producer approach. I have seen many advisors successfully have this conversation. It is very finessed. It seems very simple. But what I suggest you do is say, after you financially and medically got an idea of somebody, right, you pre-qualified them, so to speak, you say, look, Mr. Insured or Mr. Client, I can help you in one of 2 ways. I can help you transfer the risk of possibly needing care. Again, I'm not saying you will, but if you did, what would the consequences be? That's why we're talking, right? I could transfer the risk of you possibly needing care to an insurance company, and you pay this fee called a premium for it every year or month or whatever works for your situation. Or I can help you do what you thought you wanted to do anyway, and what you came in here saying you were going to do, which is self-insure. But I can help you self-insure better and longer than you do it on your own. Would you mind if we discussed both of these options? Now, what I said seemed very simple. Basically, what I said was, hey, Mr. Client, I can give you a traditional product or a hybrid product. Do you want to talk about them? That's a pretty easy thing to say no to. But when you've gone in and you've said, hey, Mr. Client, I can help you in one of 2 ways. You're providing options. Easier, yes. I can help you transfer the risk of possibly needing care, or I can help you, by the way, you said help about 4 times. That's another little sales psychology thing. Do exactly what you wanted to do. Well, now you're helping me achieve my goals. I can help you self-insure better and longer than you do it on your own. You can do it better than me. How can you do that? Now you piqued interest. So when you get to the point of, would you mind if we discussed both of these options? Most of the time I heard the client saying yes. So here's where you go from here. Transfer one more slide. Look, Mr. Client, this is kind of your portfolio and what you look like. And when people tell me they want to self-insure, they usually do it with a life insurance policy or an annuity that they bought many moons ago for different reasons than why they still have it today. 30 years ago, you bought that life insurance policy because you were still working. You were the breadwinner. The house wasn't paid off. The kids weren't through school. There needed to be a replacement for that, right? Well, now you're retired. The house is paid off. The kids are through school. You have barely any debt and you're saving. Well, why do you still have that life insurance policy? Because you're trying to self-insure your long-term care risk. But I promised you I could help you self-insure better and longer than you do it on your own. So if I pack that life insurance policy, advance one slide for me, into this thing called a 1035 exchange, I just made that small sliver of your pie significantly larger. How did I do it? Well, it's called a 1035 exchange into a long-term care insurance policy. And if you, let's advance one more slide, think for a second you might die and never need it. I can add a rider, it returns it to the original sliver. I could add another rider if you want 80% of your money back on or after the 4th year, if you ever think you might even consider canceling this thing. And I love the picture of the couple in the upper right-hand part of the slide because they're looking at each other kind of bewildered. I saw clients ask advisors and me, how do you do this? Is this legal? Why has nobody ever told me about this before? Let's advance one more slide. The answer, folks, is the stuff we've already talked about on this call. It's a long-term care insurance policy. And if you live and need care, you could design a policy with lifetime benefits or 3 pools of money. Advance one more slide. If they die and don't, you can add a return of premium rider. On one more slide, if they even think they might consider canceling this thing, add the surrender value. So advance one more slide. This is the one that says traditional long-term care insurance can be what you want it to be. This goes back to where I began. This is an extremely flexible, moldable, competitively priced product that can fit many scenarios, whether it's a hybrid conversation, whether it's a traditional conversation, and we can give you talking points on why you should or shouldn't have a return of premium or a death benefit or a hybrid or a traditional. The leverage within this policy is tremendous, and if you position it the right way, you will have tremendous success in offering this product and flexing it into what the client says is important to them. So with that, Lisa, I'd welcome any questions or any comments at the end, any Q&A. I just want to make sure everyone enjoyed the time today. I appreciate you taking the time, and we want to do all we can to earn your business. I know we have a great product, but let us show you how great our service and support can be as well as we continue to be partners together. So thank you very much, and we look forward to working closely with you.
Well, thank you, Lawrence. This has been very informative. Just a couple questions here. Is it typically 90-day elimination, or and is it service days or calendar days?
Yeah, so on EP, most of this is sold with a 90-day. We are a service day, and most people get kind of hung up on that. But remember, when you go on claim, you need help with an activity of daily living, not an activity of 3 days a week living. So when folks know they need to get someone in that house every day for 90 days, they do it. We just have to make sure we're explaining to them how the policy works, right? Now, one thing most people don't notice because they never really look, our 180-day EP is priced extremely well. In some cases, it's like $1,000, $1,200 less a year. If someone's going to pay that premium for 30 years, that's a lot of money. Yeah, they'd have to cover an additional 90 days out of pocket, but if you saved them $30,000+ in premium payments, it's worth it. So if they have the ability to cover some of that upfront risk, the 180-day EP is a very compelling option, and we have it priced very well.
Right. I would agree with that. Do you, so if, say somebody goes with lifetime or 10 pay and they're in the pay-in, mode on it, and they go on claim, do you guys waive premium at that point, or are they still having to pay premium while they're collecting
on
benefits?
The 10 pay, there's still a waiver of premium. Yep. And if, for example, you go on claim for years 6, 7, and 8, and then you get better, Well, you've only got years 9 and 10 left, and you're still paid in full. You don't have to backtrack. So there is still a waiver premium on a 10 pay. Absolutely.
Nice, very nice. So one of the things that we have kind of been working with advisors on here, One Resource Group, is going after those business owners and the executive carve out like we've got here. One, is that an easy process? And do you require a census on those type of options?
We don't require a census. The only reason we might need one is for quoting support. It is not required to get one approved. So going about them, if you have those relationships, have the conversation. If you want talking points, I know Lisa and I would be more than happy to give them to you. And next steps in terms of quoting really just depends on whether or not it's voluntary or employer paid and the size of the group. We may not need a census if they're only carving out 3 people, just run 3 individual quotes, right? And run it at that unisex rate class. So it just depends on your situation, but happy to work closely with you to see what we can do to help.
So what is the minimum? Is there a minimum that we would need? I think you mentioned it earlier, but I'm not sure on how many people that you would have to have.
Yeah, we'll look at just about any business that has at least 5 employees in it, as long as they're not called, bomb testers or explosive jugglers LLC. We're probably not going to ask any questions, and we'll simply approve the group because we're going to underwrite the individual, right? So just about any business that has at least 5 employees, and minimum participation is going to vary by state between 2 and 5 issued employee lives.
Okay, so just to reiterate that last part there, if they've, apply and they've got 5 individuals that are applying for the group, discounts or, the carve out, the worksite product route, and only 4 of them get approved, they still would be available to get that business owners and worksite options discount, correct?
Well, no, because the minimum is based on issued employees, so it depends on the state, right?
It is, okay.
So if they have at least 5 employees in the business, and say it's a state where the minimum participation's 2, which most states are, right? And that's 2 issued employee lives. Say they submit 4 apps. If 3 of them get declined, we got a little bit of a problem. But as long as 2 of those 4 employees get issued, then you're in good shape.
Okay. Well, I think that's all on the questions. Once again, Lawrence, I thank you for taking the time to discuss National Guardian Life's products with us. It's been very informative. Please don't forget to check out our LinkedIn showcase page here for One Resource Group. We have useful information out there, and we're going to be hopefully doing a podcast with Lawrence here coming up too. And so be on the lookout for that. But we thank everybody for attending this webinar today and being patient with the technical issues that we were having, and hope everyone has a great day.
Thank you all very much, and thank you, Lisa, for helping set everything up. We appreciate it, and we appreciate all of you, and look forward to your business.